All right, welcome to Talk Tickers. Today we're diving deep into Rogers Corporation's latest Q3 earnings. Now, this is a really interesting company, right at the center of huge growth markets like electric vehicles and 5G. The results? Pretty strong. The guidance? A little more cautious. So let's break down what it all means for the stock. And the market's verdict? Well, it came in loud and clear. The stock popped a solid 5.6% the day after the numbers came out. And what that tells you is that despite that cautious outlook, investors were really impressed with what the company pulled off in the third quarter. So what exactly got everyone so excited? So here's how we're going to break it down. First, we'll hit the headline numbers that caused that jump. Then, we're going to look under the hood at the turnaround story that management is pushing. After that, we'll cover their guidance and what's next on the horizon. And of course, we'll wrap it all up with our take ahead of the next earnings call. Okay, let's get right to the good stuff. The bottom line is that Rogers delivered a really clean beat against what Wall Street was expecting, and that's what immediately got everyone's attention. So check out these numbers. Revenue came in at $216 million, sailing past the consensus estimate. But the real star of the show, that was the adjusted earnings per share. At 90 cents, it absolutely crushed the 70-cent consensus. I mean, that points to some seriously strong operational execution. Now, this chart is super important because it shows the difference between the official, by-the-book GAAP earnings and the adjusted number. You can see the adjusted figure, which backs out things like one-time restructuring costs, was nearly double the official number. It shows you that smart investors are looking right past the temporary noise to see the core underlying health of the business. And the good news just keeps coming. Gross margin expanded by a very healthy 1.9 percentage points just from the last quarter. They generated over $21 million in free cash flow, and they even bought back $10 million of their own stock. I mean, that's management putting their money where their mouth is, right? It's a huge vote of confidence. So, the big question is, how'd they do it? This performance wasn't some fluke driven just by higher sales. No, this quarter was really a proof point for management's turnaround plan. It shows they're executing. Let's look at what was really driving these numbers. It was really a combination of things working together. You can see their cost-cutting initiatives are really starting to pay off. A better product mix helped boost profits, and they were just super disciplined on their expenses and managing their inventory. All of that flows directly to that stronger margin and cash flow we just talked about. And hey, don't just take my word for it. Here it is straight from the top. The interim CEO, Ali El-Haj, said they are intensely focused on costs and growth. That's not just corporate speak. That's a signal to the market that the discipline we saw this quarter, that's the new normal. This chart really helps paint the picture of that product mix. You see, the biggest growth engine this quarter was portable electronics. Industrial and aerospace also stepped up to help carry the load. So get this, even with the all-important EV market just kind of treading water, strength in other areas was more than enough to deliver that big beat. Okay, so Q3 was a home run. But what about the road ahead? This is where things get a little more interesting. Management's guidance for the fourth quarter suggests a sequential dip, but they're framing it as a totally normal seasonal pattern. Now, you can see the forecast here shows a clear step down from Q3's awesome results. Revenue, gross margin, earnings, all guided lower. And at first glance, you might look at this and think, whoa, hold on a second, is the party over? But context here is everything. And here is that all-important context. Management says this dip is due to normal seasonality. Think about it. The electronics cycle cools off after all the holiday gadgets are built, and big industrial customers often trim their inventory as they close out the year. This is pretty much textbook for their business cycle. And this, right here, this is the crucial point. This is what the market really grabbed onto. Despite that quarter-over-quarter dip, management said they expect year-over-year improvement. What does that mean? It suggests the underlying positive momentum of the business is still there, even with this seasonal noise. The turnaround is still on track. All right, let's put it all together and land the plane here. What's our take as we look ahead to the next earnings call? Here at Talk Tickers, we're initiating coverage with a specific rating and, of course, a potential trade idea. Our rating on Rogers Corporation is outperform. We believe the stock is set up to do better than the broader market over the next year. So why outperform? Here's our thinking, plain and simple. First, that positive stock reaction shows us the market cares more about strong execution on margins than it does about some near-term seasonal softness. Second, management is building real credibility here. They're delivering. And finally, they've hinted at a return to growth in the first half of 2026, which gives investors a clear positive catalyst to look forward to. Okay, so how could you play this? Here's a trade idea to chew on. If you think the market might overreact to that seasonal Q4 guidance, you could consider selling cash-secured puts. It's an option strategy, but here's the simple version. You get paid cash today, that's the premium, in exchange for agreeing to buy the stock at a lower price in the future if it drops. It's a way to generate income while setting yourself up to potentially buy into a great company at a discount. And of course, we have to be crystal clear, this is not financial advice. This analysis is just for informational purposes. You should always do your own research before making any investment decisions.